Welcome to Killik & Co.'s podcast for the 15th of July. Last week we saw very strong equity markets across the globe. They were driven by comments that came out from the FOMC and Ben Bernanke, who was discussing the interest rate decision, and really in the after comments he became much more dovish than he was seen back in May. At that time, you may recall, he referred to the scenario under which they would taper the QE programme, but it just felt this time around that he was indicating that we were still some way from that particular scenario, and as I mentioned, he was dovish in his approach, indicating around interest rates. It did lead to a decline in US 10-year yields, which had been pushing higher, but more importantly it resulted in a very strong turnaround for stock prices. Over here in London, the FTSE 100 is now trading at 6,600, and it was only a matter of what feels like days ago that the market was toying with the idea of 6,000 and going below that particular number. So a 10% rally in the FTSE 100 over time has meant that May, June and the early part of July have now proved to be very volatile, but certainly at the moment the head is towards all-time highs. As we'll see shortly, US markets are already through that particular level. They didn't come away or fall too sharply back in June, but they've certainly recovered their poise and are now pushing to high territories. Turning to this week, well, it's Ben Bernanke back on centre stage. He has 2 days of speeches on Wednesday and Thursday, speaking at the Senate, and again, the speech will be quite closely scrutinised for follow-up confirmation of the dovish tones from last week. We'll also have minutes out from the Bank of England. This will be interesting because it will give a first insight as to that first meeting that took place with Carney in charge. Where did he vote? How did he vote? Did he vote for more QE? That's some of the questions that will be answered this week. We'll also hear from the Bank of Japan, where, whilst they're not quite centre stage, it is fair to say that the turnaround in the yen weakening and the stock markets moving higher means that broadly the bull market that we saw for the first 4 to 5 months seems pretty much intact. So turning to the diary for the week ahead, this is the first screen. In black are the highlighted companies on which Killik & Co has a view and will be commenting upon during the course of the week during the morning meeting. As you can see, that there are more companies reporting this week. We are getting into the end of the Q2 sessions. Alcoa last week, which is always the first company to break news, will be followed up this week with more companies reporting, so it'd be interesting. Down on Friday we have Whirlpool, and this is one of the companies that has featured in our new thematic note, which is the rise or the return of the superpower. We're looking at 3 particular angles of the US economy that are driving growth and resumption of growth back in the US, and we've picked 4 or 5 stocks which are included in that theme. A couple from the UK, Wolseley being one, but in the US the drive in consumer goods is a reason for buying Whirlpool, and their results will be coming out on Friday. Turning to some of the charts for the week, want to not lose sight of what is happening with the commodity of oil. Oil prices act, as we know, pretty much as a tax on society. By filling up cars, and up until now the story about shale resource in the US has to some extent taken the heat out of the oil price, but I don't want to lose sight of it. It's just nudged towards a year-to-date high, and as a result of that we need to ensure that whilst there's a general sense of bullishness around about economies, we're seeing more and more surveys indicating optimism is rising, that oil doesn't come up and creep up on us and act as a bit of a brake on that at some point in the future. So one to watch in the oil market. In terms of stocks, a few interesting stocks that were around last week. One thing that we haven't seen up until now is a resumption of capital growth or indeed merger and acquisition activity, but last week we saw Invensys announce that Schneider had put in an indicative offer for the business. The company works in the area of controls. It is a global business, often described as a fairly unique asset, and we for one felt that if one company went for it, others may well follow. And at the weekend the Sunday Times mooted that GE Capital may well be interested in putting in a rival offer for the business. business. So we could get our first competitive takeover in the UK seen for some time, and as I say, the shares surging towards the end of last week. One stock that wasn't having such a happy time of it was Serco, a company that has been on our buy list and indeed was hitting all-time highs towards the end of the prior week. But last week it became involved in allegations of mischarging over the electronic monitoring program. It was tied in with G4S, and Serco immediately issued a statement to indicate that the company would obviously comply with all the inquiries, and if there has been overcharging, they will obviously repay that money. But the key to it all is that around 60% of their business is pretty much UK driven and towards the UK government, central and local government areas, and it's a sentiment issue which will take, we suspect, some time to recover from in terms of winning new business with the government. So as a result of that, we've moved Serco back from a buy back into a neutral, with the suspicion that over the course of the next few months there's probably going to be better places to deploy capital during that time. In terms of some of the index charts, I wanted to highlight the S&P index. This is obviously a very long dated chart, but really just to indicate that sort of latest surge that we've seen in the S&P, taking it to all-time highs. That same index over the course of the sort of 1 year chart, again really just highlighting that having shied away from this peak that was achieved in May, it didn't come back far, but it's recovered it in the space of 2 or 3 weeks, now heading towards new high territory. In terms of some of the currency movements, obviously last week's movements did some way to reverse the dollar strength that we have seen recently. As a result of that, sterling and both euro were rallying quite hard against the dollar. The sterling moving back up from the sort of 148 level back through to 151 at the moment, so keeping everything in a sort of fairly heavy status quo. And finally, just that chart of the US 10-year at the moment. The only observation to say is that whilst equities obviously took the dovish tone from Ben Bernanke last week in a very positive fashion, the yields haven't come back far. They're still trading around 2.57% at the moment, so still slightly indicative of the growth tack with higher interest rates to come. So we'll be again watching that week after week closely for signs of the next turn.